My piece over the weekend was called The Platform Economy. The strategy, like big techs, is to be the platform, said Bob Collymore to the Africa Report, whether it was for the banking industry, the healthcare industry, the agriculture industry. Last week, Uber filed with an initial offering amount of $1 billion, typically a placeholder amount, meaning that they'll ask for more. The company applied to list on the New York Stock Exchange under the ticker Uber. In the IPO prospectus, the word platform appears more than 700 times. Uber is seriously ubiquitous, and I recall how it arrived here in Nairobi and made its Gladwellian level move. The tipping point is that magic moment when an idea, trend, or social behavior crosses a threshold, tips, and spreads like wildfire. The new high-tech, millennial, crypto, avocado economy exhibits viral, wildfire, and exponential and even non-linear characteristics, not unlike Ebola. Uber cites a preferred metric, monthly active platform consumers, otherwise known as people who touch one of its services at least once a month. Uber says it has 91 million MAPCs, more than double the number in 2016. So now you know that when you call your Uber, you're in fact one of 91 million MAPCs. Uber posted a $3 billion operating full-year loss on revenue of $11.3 billion, bringing total operating losses over the past 3 years to more than $10 billion. Thursday's filing shows. In a brilliantly counterintuitive move, Uber even said they might never make a profit ever. Ride-hailing revenue grew 95% in 2017 from the previous year. The rate slowed to 33% last year. Uber argues that its share of the entire global transportation business is less than 1%. Argues its platform positions it to become all things transportation, encompassing everything from scooters and bicycles to freight delivery, driverless vehicles, and even flying cars. Bloomberg. Uber's food delivery business grew 149% year-on-year to $1.5 billion in revenue in 2018. Uber is seeking to raise about $10 billion at a valuation of around $100 billion. The punchline is this is the largest high-growth tech company that's going to be going to the public markets. David Erickson, a finance professor at the University of Pennsylvania's Wharton School. My perspective is that investors will look through the accumulated losses and focus on the ubiquity of the platform, and that therefore these shares will pop meaningfully. Therefore, if the IPO price range is between $100 to $110 billion in market cap, I would be a buyer looking for a move towards $150 billion. This is therefore a conviction buy recommendation within those parameters. Clearly, if it comes at a lower price because they're uncertain post-lift, then you'll get a bigger margin in my view. Now let's turn to Jumia Technologies AG, listed in New York, raised $196 million with the sale of 13.5 million American depository receipts at $14.50 each. And those shares popped as much as 75% at one point. Jumia has more than 4 million customers in 14 African countries. Its retail platform isn't profitable yet. However, sales jumped by almost 40% last year to $147.3 million and has accumulated losses of just shy of $1 billion. There has been an off-the-charts debate about whether Jumia should characterize itself as an African company, given that its headquarters are in Berlin and it was initially financed by the German startup incubator Rocket Internet SC. MTN is its largest shareholder. Pernod Ricard and MasterCard recently stepped into the shareholder register. It's an opportunity for retail investors to buy the Africa growth story, the story of a growing consumer class. Rising per capita incomes, an increasingly young and urban population, falling internet and data costs, surging mobile phone penetration, These favorable long-term trends underpin the rise of the African online consumer. Investors are looking through the accumulated losses, seeing e-commerce penetration levels of 1% or less in Africa versus something like 24% in China, and betting that Jumia can parlay its first mover advantage into something like a seriously meaningful head start. Jumia is higher beta than Uber, but on balance is a buy as well on Friday's closing price basis. Interestingly, last week we witnessed the biggest single percentage move in any share price at the Nairobi Securities Exchange in more than a decade. Bharat Thakra pulled a special 3 shilling dividend rabbit out of his hat and surged WPP Scan Group's share price some 71.57%. An off-the-charts price move, once in a decade phenomenon, got absolutely zero ventilation across our media. This loops me to a comment that the UNCTAD Secretary General, Dr. Mukisa Kituyut, made to me. He said it's all about platform visibility. Africa is not visible on these Uber platforms. I expect the African platform economies to be one of the richest and most rewarding of economies going forward. Thomson Reuters sees fair value for Uber at $65 billion, 5 times revenue multiple analog to Lyft. But their revenue growth has been declining. After doubling in 2017, revenue grew 42% in 2018. This is a photograph of the New York Stock Exchange listing. It is the first African tech startup to go public. But that whole African tech startup issue is quite a big one. I addressed it with Yomi Kazim of Quartz Africa. So while the company runs the largest e-commerce business across Africa with operations in 14 countries, it is incorporated in Germany, has its headquarters in Dubai, with its central tech team based in Portugal, and as its IPO filing shows, will be listed in New York. Let me tell you, Jumia's branding as an African company, I said, is public and investor relations being played at quite a high and interesting level. They want to indigenize their brand, as successful brands in Africa tend to be adept at indigenization. It's subtle and clever marketing to cloak itself in the righteousness of the continent and seek to dilute the fact that its ownership is not on the continent. And I said it's absolutely important to be explicit about business's identity.